Imagine waking up one morning to find out that the global financial system, the very machine that keeps your world turning, has ground to a screeching halt. ATMs are dry, banks are locked, and the money in your account is evaporating by the second. Most people think a crisis like this is a freak accident. We treat economic collapses like once-in-a-lifetime natural disasters, an unpredictable earthquake that shakes our lives before vanishing back into the shadows. We tell ourselves that the system is simply too massive, too chaotic, and too unpredictable for anyone to ever see the crash coming. But what if that's a total lie? What if the devastating crashes of history aren't random accidents at all, but highly predictable events driven by an inescapable repeating rhythm? Here is the hard truth that almost everyone misses. The economy isn't a complex, mystical entity. It's a beautifully simple mechanical machine driven by human nature. And because human nature never changes, the machine follows a strict archetypal script. Every massive boom is hardwired to create a brutal bust, and every debt crisis follows the exact same pattern, playing out like a predictable three-act tragedy over and over again. When you understand the script, you stop being a victim of the financial weather, and you start becoming the person who can predict the rain. This is the ultimate playbook for anyone who refuses to be left in the dark when the next storm hits. If you are an aggressive investor looking to protect your hard-earned capital, an ambitious entrepreneur trying to navigate shifting market tides, or an analytical mind who wants to decode the hidden forces shaping our global landscape, this masterclass is for you. You are about to step inside the mind of one of the greatest hedge fund managers of our time to see exactly how the world really works. Over the next couple of hours, we are going to dissect the anatomy of financial disasters. You will learn the exact warning signs that a nation is drowning in bad credit, and you'll discover how a regular deflationary depression can rapidly spiral into the terrifying chaos of hyperinflation. We will travel through time to examine the structural fractures of the 1920s Weimar Republic, pull back the curtain on the darkest days of the Great Depression, and unpack the subprime engine that triggered the 2008 global collapse. More importantly, you will see how the world's most powerful policymakers pull the structural levers of interest rates, money printing, and asset distribution to engineering a beautiful deleveraging and drag economies back from the edge of total ruin. The economic machine is moving right now, and the clock is ticking toward the next inevitable cycle. You can either be blindsided by the waves, or you can learn how to surf them. Ready to rethink everything you thought you knew about wealth, debt, and the global machine? Let's get started. Chapter 1. Introduction and How I Think About Credit and Debt. Think about the last time you swiped your credit card for a purchase you couldn't actually afford. In that exact moment, you didn't just buy a new gadget or a fancy dinner. You actually created a miniature economic ecosystem. You initiated a transaction based on a promise. This simple, everyday human interaction is the foundational building block of the entire global financial architecture. To truly understand how massive economies collapse, you have to realize that the global economy is not some abstract, mystical cloud floating above us. It is just the sum total of all the transactions that happen every single day. At its absolute core, an economy is driven by a beautifully simple mechanical machine. But because this machine is fueled by flawed human nature, it behaves in highly rhythmic, predictable patterns. When you understand how these small individual promises aggregate into trillions of dollars, you unlock the ability to see a financial crisis coming long before it hits the evening news. To make sense of this machine, we have to start by demystifying the relationship between money and credit. Most people use these two words interchangeably, but they are radically different concepts. Think of money as the ultimate settler of accounts. When you walk into a coffee shop and buy an espresso with a $10 bill, the transaction is immediately complete. You gave them currency, they gave you coffee, and no one owes anyone anything. Now, imagine you walk into that same shop, but you pay with credit. You are effectively telling the barista, "I promise to pay you later." In that exact split second, you have created something out of thin air. You created credit, which is an asset for the coffee shop, and you created debt, which is a liability for you. This distinction is crucial because there is actually far more credit circulating in the United States than there is physical money. In fact, physical cash is just a tiny fraction of the total spending power floating around the economy. The vast majority of what we call money is actually just a massive web of promises to pay. This brings us to the ultimate engine of economic growth and destruction, the concept of credit-fueled spending. When an economy relies purely on money, the only way you can increase your spending is to increase your income. You have to work harder, produce more goods, or become more efficient. Your spending can only grow as fast as your productivity, but when you introduce credit into the mix, the entire game changes overnight. Credit gives you the superpower to spend more than you actually make. When a bank grants you a loan, your spending power instantly jumps. And because your spending is someone else's income, their income goes up too. When their income goes up, they look more creditworthy to their bank, so the bank lends them more money. This cycle creates a self-reinforcing upward spiral. Credit acts as a massive accelerator, pulling the future into the present. It allows us to enjoy a higher standard of living today by borrowing against the labor we promise to perform tomorrow. However, this accelerator comes with a massive catch that most people completely ignore during the good times. Whenever you borrow money, you aren't just taking cash from a vault. You are effectively creating a cycle. Look at it this way. When you buy something you can't afford, it means you are spending more than you earn. To do this, you are essentially borrowing from your future self. You are creating a specific time in the future where you will be forced to spend significantly less than you make just to pay back the original loan. This structural dynamic is true for an individual consumer shopping at a mall in Ohio, and it is equally true for the entire United States government. This is why credit inherently creates cycles. It is a mathematical certainty. Once you borrow, the upward climb begins, but the downward slope is already locked into your destination. It is a mechanical law, not a random fluke of bad luck. This mechanical reality means that credit is neither inherently good nor inherently bad. It is simply a powerful tool that can be used constructively or destructively. Good credit is when you borrow money to buy something that generates a return higher than the cost of the loan. For example, if a small business owner borrows $100,000 to purchase a high-tech manufacturing machine that increases production and generates $20,000 in net profit every year, that debt pays for itself. It boosts productivity and improves the standard of living. On the flip side, bad credit is when you borrow money to finance consumption that doesn't generate any income. If you borrow $50,000 to buy a luxury SUV that depreciates the moment you drive it off the lot, you haven't increased your productivity. You have simply created a heavy drag on your future financial freedom. When an entire nation fills its balance sheets with bad credit, a structural crisis becomes inevitable. As these individual cycles compound across millions of borrowers, they merge into two major macroeconomic waves, the short-term debt cycle and the long-term debt cycle. The short-term cycle is what we typically call the business cycle, and it usually lasts between 5 to 8 years. It is driven by central banks adjusting interest rates to manage inflation and unemployment. When times are good, spending increases and the economy expands. If it expands too fast, prices rise, and the central bank steps in to raise interest rates, making borrowing more expensive. This cools down spending, causes a minor recession, and keeps things in check. Then they lower rates again to spark the next rise. Most people are familiar with this rhythm because we experience it a few times every decade. But here is the catch that sets up the ultimate trap. At the end of each short-term cycle, the economy never quite returns to where it started. Human nature is fundamentally greedy and optimistic. People naturally prefer borrowing and spending more over paying back what they owe. As a result, at the bottom of every recession, politicians and central bankers pull out all the stops to get things moving again, leaving a little bit of leftover debt on the table. Over decades, these small leftovers stack up higher and higher. This slow, compounding accumulation of leverage is what drives the long-term debt cycle, a massive wave that takes roughly 75 to 100 years to play out. For decades, everything looks amazing because asset prices rise and everyone feels wealthy. But under the surface, a mountain of structural instability is growing, waiting for the single spark that will bring the whole thing crashing down. Chapter 2. The template for the archetypal long-term / big debt cycle, deflationary crises. When a country enters a deflationary debt crisis, it is watching a movie that has been played dozens of times throughout history. This specific type of collapse usually happens in countries where the vast majority of the debt was borrowed in their own local currency. Because the debt is denominated in money the nation can actually print, the crisis plays out as a slow, painful grind of asset liquidations, falling prices, and crushing economic stagnation. To understand this dynamic, you have to look at the cycle as a multi-stage process that moves through predictable phases: the early stage, the bubble, the peak, the depression, and finally, the beautiful deleveraging. It is a structural journey that completely transforms societies, redistributes wealth, and tests the absolute limits of central banking power. The journey begins in the early stage of the cycle. During this phase, debt is growing, but it is growing in tandem with incomes. This is a healthy, productive economy. If a business takes out a $1 million loan, but its revenues are growing by 15% a year, that debt is completely manageable. Lenders are happy to extend credit, borrowers are happy to take it, and the entire system feels incredibly stable. This stability, however, breeds complacency, which naturally transitions the economy into the bubble phase. This is where the psychology shifts from calculated risk-taking to pure financial euphoria. Because times have been good for so long, people begin to assume that asset prices will rise forever. Investors start buying real estate, stocks, or businesses not because of the income they produce, but simply because they expect to sell them to someone else at a higher price tomorrow. During a bubble, credit becomes incredibly easy to get. Financial institutions loosen their lending standards, creating a massive wave of speculative buying. This creates a powerful self-reinforcing loop. Rising credit drives up asset prices, which makes borrowers look wealthier, which encourages banks to lend even more money. Everyone feels rich. Look at the subprime housing boom in the United States leading up to 2008. People with no steady income were buying multiple homes with zero money down, completely convinced that home prices could only go up. At this stage, the debt service obligations, the actual monthly payments required to keep the loans alive, are growing significantly faster than the underlying incomes of the borrowers. But no one cares because they can just borrow more money against their rapidly appreciating assets to make their payments. The system is floating on a cloud of leverage, completely detached from economic reality. Eventually, the cloud hits a wall and the economy enters the peak phase. The peak occurs when the bubble can no longer be sustained by injecting more debt. This inflection point is usually triggered by a central bank trying to cool down the overheating economy by raising interest rates, or by a sudden realization among lenders that borrowers are overextended. When the flow of new credit slows down even a little bit, the entire mechanical apparatus begins to reverse. Because borrowers can no longer get new loans to pay off their old debts, they are forced to do something they haven't done in years: reduce their spending. And because one person's spending is another person's income, aggregate incomes across the entire economy begin to drop. Suddenly, asset prices stop rising. The moment prices plateau, the speculative illusion shatters, and panic sets in. This panic plunges the nation into the depression phase, which is the most painful part of the deflationary cycle. As asset values plummet, the collateral backing trillions of dollars in loans evaporates. A bank that lent $800,000 against a $1 million home suddenly finds itself holding an asset worth only $500,000. Debtors default on their loans, causing banks to suffer massive losses. To survive, banks stop lending entirely, freezing the plumbing of the financial system. This creates a vicious downward spiral known as a debt deflationary vortex. To get cash to pay their debts, people are forced to sell their assets into a market where there are no buyers. This fire sale behavior drives prices down even faster. Workers are laid off, unemployment spikes, and a deep psychological gloom settles over the country. At this point, policymakers have to act, and they have 4 specific levers they can pull to resolve the crisis. The first lever is austerity, where individuals, businesses, and governments cut their spending to save money. While this sounds logical, it actually makes the depression worse because cutting spending simply destroys more income. The second lever is debt defaults and restructuring, where lenders agree to write down the value of the loans or extend payment timelines. This reduces the debt burden, but it also destroys wealth, making investors feel even poorer. The third lever is wealth redistribution, where governments raise taxes on the rich to fund social safety nets for the unemployed. This creates massive political tension and social unrest. The fourth and most powerful lever is money printing and monetization. This is when the central bank steps in to create new currency out of thin air to buy government bonds and financial assets, pumping liquidity back into the system. This process is known as quantitative easing. In a deflationary crisis, policymakers must balance these 4 levers to achieve what is called a beautiful deleveraging. A beautiful deleveraging happens when the central bank prints just enough money to offset the deflationary forces of austerity and debt defaults. If they print too little, the economy stays trapped in a brutal depression. If they print too much, they trigger hyperinflation. Striking this balance requires incredible political skill and economic precision. When done correctly, the nominal growth rate of the economy rises above the nominal interest rate on the debt, allowing the mountain of leverage to slowly melt away without destroying the social fabric of the country. Chapter 3: Inflationary Depressions and Currency Crises. While a deflationary depression is a slow, grinding story of falling prices and economic stagnation, an inflationary depression is a violent, explosive beast. This type of crisis almost always targets countries that rely heavily on foreign capital and have accumulated a massive mountain of debt denominated in a foreign currency, typically the US dollar. When a nation owes money in a currency it cannot print, it loses total control over its economic destiny. The moment international investors lose confidence in that country's ability to repay, capital flees the borders like water from a bursting dam. This sudden exit triggers a catastrophic currency collapse, unleashing a vicious cycle of runaway inflation, skyrocketing living costs, and deep societal fracture that completely rewrites the rules of wealth overnight. To understand how this nightmare unfolds, we have to look at the anatomy of capital flows. In the good times, developing or emerging economies look incredibly attractive to global investors. These nations often offer higher interest rates and rapid growth prospects. Up-and-coming businesses and local governments in these regions look at global markets and realize they can borrow US dollars at a much lower interest rate than their local banks offer, so they gorge on foreign debt. For a while, this influx of foreign cash creates a magnificent artificial boom. The local currency strengthens because foreign investors are constantly buying it up to invest in local projects. With a strong currency, imports become incredibly cheap. Regular citizens can suddenly afford imported cars, high-tech electronics, and luxury goods from overseas. The country feels like it has officially arrived on the global stage. But this prosperity is built on a foundation of quicksand. The fundamental flaw of a foreign currency bubble is that the country becomes entirely dependent on a continuous, uninterrupted stream of new foreign loans just to pay the interest on its existing debt. The moment that stream slows down, whether due to rising interest rates in the United States, a drop in the prices of the country's main exports, or a general shift in global investor sentiment, the entire mechanical apparatus reverses with terrifying speed. When foreign lenders stop rolling over old debts and demand their dollars back, the local borrowers face a structural crisis. To pay back a dollar-denominated loan, a local business must take its revenues, which are earned in the cheap local currency, and sell them on the open market to buy US dollars. This frantic scramble to buy foreign currency triggers the peak phase and initiates a brutal currency defense. As everyone rushes to sell the local currency to buy dollars, the value of the local currency begins to plummet. To stop this bleeding, the nation's central bank will usually try to defend its exchange rate using two traditional tools. First, they spend their foreign exchange reserves, their rainy day fund of actual US dollars stored in their vaults, to buy up their own currency on the open market. Second, they skyrocket interest rates, sometimes to 30%, 40%, or even higher, in a desperate attempt to convince investors that keeping their money in local banks is worth the risk. However, this traditional defense almost always fails in a major crisis. Selling off foreign reserves is a temporary band-aid. Once those dollar vaults run empty, the central bank is left completely defenseless. At the same time, hyper-elevated interest rates act like a sledgehammer to the domestic economy. Regular businesses can no longer afford to borrow. Economic activity freezes and companies start going bankrupt. When international investors see the economy fracturing under the weight of high interest rates, they realize the country is headed for a deep recession. Instead of keeping their money there, they pull their capital out even faster. The defense backfires completely, and the currency goes into a freefall. This freefall plunges the country into the inflationary depression phase, where the falling currency creates an immediate, devastating shockwaves through daily life. Because the local currency has lost half or more of its purchasing power, the cost of everything imported from overseas instantly doubles or triples. Since modern economies rely on imported oil, machinery, medicine, and food, basic living costs skyrocket overnight. This is cost-push inflation at its worst. At the exact same time that citizens are losing their jobs due to the economic freeze, the price of milk, bread, and gasoline is compounding on a weekly basis. This is the ultimate trap. The economy is shrinking, yet prices are exploding. In a desperate bid to keep the government running and prevent total social collapse, policymakers usually resort to the worst possible tool, the printing press. Because they cannot print US dollars to pay the foreign debts, they print massive amounts of their local currency to fund government salaries, pensions, and domestic obligations. But printing more local currency into an environment where people are already panicking only adds fuel to the fire. It dilutes the value of the money even faster. The currency degrades from a trusted store of value into a hot potato that everyone wants to get rid of the second they receive it. People rush to convert their cash into physical goods, gold, or foreign stablecoins, which drives domestic prices up even higher. Resolving an inflationary depression is a far more brutal process than fixing a deflationary one, because a beautiful deleveraging is almost impossible to achieve when your currency is rejected by the world. The only way out of this trap is through severe structural pain. The country must go through a massive forced rebalancing. Imports must be drastically cut because the nation can no longer afford them, and exports must be ramped up to earn actual foreign currency. Often the government has no choice but to formally default on its foreign debts, locking itself out of global capital markets for years. Ultimately, wealth is aggressively redistributed, living standards take a massive step backward, and the entire economic machine must be painfully rebuilt from the ground up on a foundation of real productivity rather than borrowed foreign illusions. Chapter 4. German Debt Crisis and Hyperinflation, 1918 to 1924. To truly understand how an inflationary depression can completely untether an entire society from reality, we have to look at the Weimar Republic of Germany following World War I. This is the ultimate cautionary tale of what happens when a nation is buried under a mountain of debt it cannot print and decides to use the printing press as a political escape hatch. In less than a decade, one of the most advanced, industrialized, and cultured nations in the world watched its currency degrade from a symbol of European economic might into a worthless piece of paper used as wallpaper, kindling for stoves, and toys for children. It is a historical masterclass in how economic mechanics, when pushed past their breaking point by flawed human nature and political desperation, can trigger total societal and institutional collapse. The roots of this crisis were planted deep during the war itself. Unlike Britain or France, which financed their war efforts partly through income taxes, the German government decided to fund World War I almost entirely through debt. They borrowed heavily from their own citizens, fully believing that they would win the conflict and force their defeated enemies to pay off those massive bills. When Germany lost the war in 1918, that gamble failed catastrophically. The newly formed Weimar government was left with a domestic economy that was completely exhausted, heavily indebted, and deeply fractured. But the ultimate blow came in 1919 with the signing of the Treaty of Versailles. The victorious Allies imposed massive, punitive reparations on Germany, demanding the country pay $33 billion, an astronomical sum at the time, in gold, commodities, and foreign currencies. This created the exact structural nightmare we explored in the previous chapter. Germany owed a massive mountain of debt, denominated in assets and currencies that it could not print. If the Weimar government wanted to pay the Allies, they had to convert their local currency, the mark, into gold or foreign cash like US dollars or French francs. To make matters worse, Germany's industrial heartland had been stripped of key resources, severely limiting its ability to export goods and earn that foreign money naturally. International investors saw this imbalance and immediately realized that the German government was fundamentally insolvent. Capital began fleeing the country, and the international value of the German mark started to rapidly slide. Faced with massive domestic unemployment, an unpayable foreign debt burden, and intense political instability, the German central bank, the Reichsbank, chose the path of least resistance. They decided to print money to buy foreign currency and pay their bills. In the early stages of this process, from 1920 to 1921, the system experienced a deceptive, artificial boom. Because the government was pumping new money into the economy, nominal wages went up and factories were buzzing with activity. To a regular observer on the street, it looked like Germany was magically recovering from the war, but under the surface, the structural foundation was rotting. The more marks the central bank printed to dump onto the global foreign exchange markets to buy dollars and gold, the faster the value of the mark depreciated against the rest of the world. By late 1922, the situation reached a critical breaking point. Germany began failing to meet its scheduled timber and coal reparation deliveries to France. In response, in January 1923, French and Belgian troops marched across the border and occupied the Ruhr Valley, Germany's most vital industrial and coal-producing region. The German government, furious but militarily powerless to fight back, called for a campaign of passive resistance. They instructed the workers in the Ruhr to go on a general strike and completely stop producing goods for the occupying forces. To support these striking workers and their families, the German government made a fateful, catastrophic decision. They promised to pay their full wages while they sat idle. With no tax revenues coming out of their most productive industrial region, and with massive new spending obligations to millions of striking workers, the government completely unhooked the printing presses from reality. The Reichsbank began running its printing operations 24 hours a day, 7 days a week. This action instantly converted a severe inflationary depression into the terrifying, uncharted territory of hyperinflation. The cycle became completely detached from traditional economic limits. In 1914, before the war, a US dollar was worth about 4.2 German marks. By the summer of 1923, a dollar was worth 1 million marks. By November of that same year, a single US dollar was worth an unimaginable 4.2 trillion marks. During the peak of this madness, in the fall of 1923, daily life in Germany became a surreal struggle for survival. Money lost its core function as a store of value and became a hazardous liability. Prices in restaurants and grocery stores changed by the hour. Workers were paid twice a day, and they would immediately hand their stacks of cash to their wives through factory fences, so the money could be rushed to the nearest store and spent before it lost its value by evening. People carried cash around in laundry baskets, wheelbarrows, and suitcases. A loaf of bread that cost a few marks a year prior suddenly cost billions, then hundreds of billions of marks. This hyperinflation completely wiped out the German middle class overnight. Anyone who had spent a lifetime diligently saving money in a bank account, holding government bonds, or relying on fixed pensions watched their entire life's work reduced to absolute zero. Meanwhile, speculators who borrowed massive amounts of marks to buy physical real estate or factories made fortunes because they could pay back their massive loans with a single worthless banknote. This total inversion of financial reality shattered the moral and social fabric of German society. Hard work, thrift, and saving were punished, while speculation and financial chaos were rewarded. The nightmare finally ended in late November 1923 through a radical monetary stabilization plan engineered by a new government coalition and financial expert, Hjalmar Schacht. They realized the old currency was completely dead, so they killed it entirely. They introduced a brand new temporary currency called the Rentenmark. Because the government had no gold to back this new money, they backed it with a legal mortgage on all the physical land, agricultural property, and industrial assets in Germany. They strictly capped the total amount of Rentenmarks that could ever be printed. Simultaneously, the government aggressively cut spending, laid off hundreds of thousands of public workers, and negotiated a new realistic repayment schedule with the Allies under the Dawes Plan. Confidence returned almost instantly. Prices stabilized and the machine was reset. But the deep psychological and political scars left by the hyperinflation created the exact fertile ground that radical political movements would exploit over the decade that followed. Chapter 5. U.S. Debt Crisis and Adjustment, the Great Depression, 1928 to 1937. To understand how a deflationary debt crisis can bring the most powerful economy on earth to its knees, we have to look at the United States during the Great Depression. This era is the ultimate historical case study of a classic long-term debt cycle reaching its absolute mathematical limit. It shows how decades of compounding optimism, easy credit, and speculative euphoria can build a mountain of leverage so massive that when it finally fractures, it triggers a catastrophic collapse that traditional economic policy cannot easily fix. It is a story of how a nation had to completely reinvent its relationship with money, banking, and government intervention just to survive the fallout of its own financial success. The story begins in the 1920s, a decade famously known as the Roaring Twenties. This was a period of unprecedented industrial expansion, technological innovation, and soaring consumer confidence. The widespread adoption of automobiles, electricity, radios, and assembly line manufacturing completely revolutionized American life. Because the underlying economy felt incredibly strong, a profound psychological shift occurred among everyday citizens and financial institutions alike. People began to believe that the United States had entered an era of permanent prosperity. This unbridled optimism triggered a massive wave of speculative borrowing. For the first time in American history, buying on credit became a mainstream cultural phenomenon. People didn't just borrow money to buy houses or cars. They borrowed money to buy stocks. Wall Street brokerage firms introduced margin loans, allowing regular retail investors to buy shares of companies by putting down as little as 10% of their own cash and borrowing the remaining 90% from the broker. This setup created a powerful self-reinforcing bubble. The massive influx of borrowed money drove stock prices to dizzying heights, which made investors look incredibly wealthy on paper. This paper wealth gave banks the confidence to extend even more credit, fueling an explosive speculative mania that completely detached asset prices from their actual earnings. By 1928, the Federal Reserve became increasingly alarmed by the sheer volume of speculative credit flooding the New York stock market. In a deliberate attempt to cool down the overheating bubble and deter speculation, the central bank began steadily raising interest rates. This move marks the peak phase of the cycle. Raising interest rates made borrowing more expensive, which slowly began to constrict the flow of new credit into the market. Without a continuous expanding stream of fresh debt to bid up stock prices, the speculative momentum began to stall in the summer of 1929. The moment prices plateaued, the structural fragility of a highly leveraged market became painfully obvious. Investors who had borrowed 90% of their portfolio's value suddenly faced margin calls, forcing them to sell their shares at any price to pay back their brokers. This panic culminated in October 1929 with the infamous stock market crash. Black Tuesday struck Wall Street, unleashing a violent downward spiral that wiped out billions of dollars in wealth in a matter of days. But the crash was just the visible tip of a much deeper structural iceberg. The true nightmare of the Great Depression was the systemic banking collapse that followed. Throughout the 1920s, thousands of small rural banks across the United States had invested their depositors' savings into speculative real estate and agricultural loans. As defaults trickled in and stock market collateral evaporated, these banks became fundamentally insolvent. Terrified citizens realized their savings were at risk, triggering massive bank runs. Lines of frantic depositors wrapped around city blocks as people rushed to withdraw their physical cash before the bank ran dry. Because banks operate on a fractional reserve system, meaning they keep only a small percentage of deposits in cash and lend out the rest, they could not meet the sudden demand. Between 1929 and 1933, over 9,000 American banks collapsed, completely erasing the life savings of millions of families and freezing the financial plumbing of the United States. This collapse plunged the country into a deep, deflationary depression phase. The total money supply in the United States contracted by roughly 30% as credit completely vanished. With the financial system paralyzed, a brutal debt deflationary vortex took hold. To survive, businesses and individuals cut spending to the bone to save every dollar for debt repayment. But as we explored in the core template, cutting spending simply destroys someone else's income. Aggregate demand plummeted, forcing factories to shut down, assembly lines to halt, and companies to lay off workers en masse. By 1933, unemployment in the United States skyrocketed to a staggering 25%, meaning 1 out of every 4 able-bodied Americans was out of work. During the initial years of this collapse, from 1929 to 1932, the federal government under President Herbert Hoover and the Federal Reserve made a critical mistake. They leaned heavily into the wrong policy levers. They believed that the economy would naturally heal itself through austerity and liquidation. They kept the money supply tight and resisted aggressive intervention, fearing it would trigger inflation. This rigid adherence to old economic dogmas allowed the deflationary forces to run completely out of control, worsening the depression and pushing the social fabric of the country to the absolute brink of revolution. The turning point finally arrived in March 1933, with the inauguration of President Franklin D. Roosevelt, who immediately initiated a radical pivot toward a beautiful deleveraging. Roosevelt understood that to break the deflationary cycle, the government had to aggressively pull the printing and reflation levers. On his first full day in office, he declared a national bank holiday, temporarily closing all banks to halt the panic and allow federal auditors to stabilize the healthy institutions. He then launched the New Deal, a massive series of government-funded public works programs designed to inject income directly into the hands of unemployed workers. More importantly, Roosevelt enacted a profound monetary shift by breaking the tight constraints of the gold standard. He ordered citizens to turn in their gold coins to the government and formally devalued the U.S. dollar against gold. This freed the Federal Reserve from its structural golden handcuffs, allowing the central bank to aggressively print money and inject massive liquidity back into the banking system. Simultaneously, the federal government created the Federal Deposit Insurance Corporation, FDIC, to guarantee bank deposits, instantly ending the phenomenon of bank runs by restoring public trust. By balancing the painful realities of debt write-downs with aggressive monetary expansion and government spending, Roosevelt successfully offset the crushing deflationary forces. The nominal growth rate of the economy finally rose above the cost of the debt, laying the long, hard floor for America's eventual economic recovery. Chapter 6, U.S. Debt Crisis and Adjustment, the Financial Crisis, 2007 to 2011. To understand how the modern global financial system can suddenly find itself on the brink of absolute annihilation, we have to look at the Great Recession of 2008. This crisis represents a 21st century mutation of the classic long-term debt cycle. While the Great Depression of the 1930s was driven by traditional bank runs where citizens physically queued up on city sidewalks to demand their cash, the 2008 collapse took place in the shadows. It was a digital run on a complex, highly engineered parallel banking system that most everyday Americans didn't even know existed. It proved that no matter how sophisticated financial engineering becomes, it cannot outsmart the basic mathematical laws of leverage and human greed. The seeds of this modern crisis were planted in the early 2000s, right after the dot-com tech bubble burst. To protect the U.S. economy from a deep recession, the Federal Reserve slashed interest rates to historic lows, down to just 1%. This flood of cheap money made traditional safe investments, like government bonds, yield next to nothing. Wall Street investment firms and global institutions began frantically hunting for higher returns. They found their answer in the American real estate market. At the same time, a massive narrative took hold across the United States, the unshakable belief that home prices could never go down on a national scale. This single flawed assumption became the foundation for a multi-trillion-dollar speculative bubble. Financial institutions began aggressively pumping credit into the housing sector, birthing the era of subprime lending. Banks completely threw traditional lending standards out the window. They began offering mortgages to borrowers with poor credit histories, low incomes, and no assets, loans famously known as ninja loans, no income, no job, or assets. To supercharge this process, Wall Street engineers invented a financial alchemy known as securitization. Investment banks bought up thousands of these risky subprime mortgages, bundled them together into massive financial pools called collateralized debt obligations, CDOs, and used complex mathematical models to slice them into different risk tiers. They convinced credit rating agencies that because these mortgages were spread out across different states, they were completely safe, earning these toxic bundles coveted AAA ratings. This created a massive self-reinforcing upward spiral. Wall Street had a voracious appetite for more mortgages to turn into CDOs, so they pushed local mortgage brokers to lend even more money. This easy credit drove home prices sky high, which made subprime borrowers look richer on paper and allowed them to refinance their homes to take out extra cash. The financial system was floating on a massive ocean of hidden leverage. Major investment banks were borrowing $30 for every $1 of their own capital, using short-term lending markets to finance long-term, illiquid mortgage bets. The turning point and peak phase arrived between 2004 and 2006, when the Federal Reserve steadily raised interest rates from 1% to 5.25% to curb creeping inflation. This rate hike acted like a slow-motion wrecking ball to the subprime market. Many subprime mortgages had adjustable rates, meaning after an initial teaser period, the monthly payments skyrocketed. By 2006, millions of homeowners found their monthly bills doubling. Concurrently, the artificial demand driving the housing market collapsed, and home prices plateaued before starting to fall. Borrowers suddenly realized they owed $500,000 on a house that was now worth only $300,000. They couldn't sell, they couldn't refinance, and defaults began to skyrocket. By 2007, the subprime rot began to poison the global financial architecture because these toxic mortgages had been sliced, diced, and distributed to banks, pension funds, and insurance companies all over the world. No one knew exactly who was holding the bad debt. Trust completely evaporated. This uncertainty triggered a catastrophic freeze in the shadow banking system, specifically in the repo market, where banks trade short-term loans overnight. Banks stopped lending to each other because they feared their peers might go bankrupt the next morning. The crisis reached a violent crescendo in September 2008 with the spectacular collapse of Lehman Brothers, a 158-year-old Wall Street investment powerhouse. The federal government decided not to bail Lehman out, allowing it to plunge into bankruptcy. This single event unleashed global financial panic. The credit markets completely froze overnight. Regular corporations couldn't secure loans to meet payroll. Global trade slowed to a crawl, and the world's largest insurance giant, AIG, found itself hours away from total collapse due to trillions of dollars in complex derivative bets it couldn't honor. The global economic machine was facing systemic cardiac arrest. Faced with the terrifying prospect of a second Great Depression, American policymakers led by Fed Chairman Ben Bernanke and Treasury Secretaries Henry Paulson and Timothy Geithner realized they had to act with unprecedented speed and scale. They abandoned old rulebooks and aggressively deployed the printing and reflation levers to engineer an incredibly complex, modern, beautiful deleveraging. First, Congress passed the Troubled Asset Relief Program, TARP, a controversial $700 billion taxpayer-funded bailout designed to inject capital directly into the nation's largest banks, stabilizing the financial plumbing by force. Simultaneously, the Federal Reserve took emergency measures that permanently altered central banking. They slashed interest rates all the way to absolute zero. When that wasn't enough to restart the economy, they launched quantitative easing, QE. The Fed created trillions of dollars out of thin air and used that new currency to buy up toxic mortgage-backed securities and government bonds directly from banks. This massive injection of artificial liquidity put a permanent floor under asset prices, cleansed the balance sheets of financial institutions, and kept interest rates at historic lows. While these unprecedented actions prevented a total systemic collapse and guided the United States into a slow, grinding recovery, they also sparked intense political debate over corporate bailouts and wealth inequality, proving that the tools required to fix a massive long-term debt crisis always come with a steep social price tag. Chapter 7. Comprehensive 100-Year Historical Registry and Charts. When you step back from the granular details of individual crises, you begin to see that economic history is not a collection of random, disconnected events. It is a massive, overlapping tapestry of repeating patterns. To prove this mechanical reality, Ray Dalio and his research team conducted an exhaustive empirical study, assembling a comprehensive 100-year historical registry that tracks 48 of the most significant big debt crises across modern history. By gathering, normalizing, and charting nearly a century of macroeconomic data, spanning output, debt loads, interest rates, stock market valuations, and central bank balance sheets, the registry strips away the unique political noise of different eras to reveal the raw, unchanging mathematical skeletons of financial cycles. The true power of this historical registry lies in its ability to show us the standard aggregated path of a debt cycle through data visualization. When you overlay the charts of 48 different depressions, whether it is the American collapse of 1929, the Japanese post-bubble stagnation of the 1990s, or the European sovereign debt crisis of 2010, the structural similarities are staggering. The registry compiles these individual case studies to create an aggregated composite chart of a typical long-term debt cycle. This composite chart acts like a universal map. It shows that in almost every single case, debt to GDP ratios climb at an identical, unsustainable angle during the bubble phase. Asset prices peak within a very narrow statistical window relative to interest rate hikes, and the subsequent drop in economic output follows a highly predictable trajectory. One of the most profound insights revealed by this data registry is the precise mathematical behavior of debt service burdens. Most analysts look purely at the total volume of debt a country holds, but the registry proves that total debt is a deceptive metric. What actually breaks an economy is the debt service ratio, the percentage of total income that individuals, corporations, and governments must allocate just to pay the interest and principal on their loans. The data charts demonstrate that during the late stages of a bubble, even if interest rates are relatively low, the sheer volume of accumulated debt means that total debt service obligations swell to historic highs. The moment income growth slows down even a fraction of a percentage point below the interest rate, the debt service loop turns toxic, forcing a systemic wave of defaults. Furthermore, the registry systematically categorizes the 48 case studies into two distinct buckets: deflationary debt crises and inflationary debt crises. By looking at these two groups side by side through historical charts, the fundamental divergence in central bank behavior becomes crystal clear. In the deflationary registry, predominantly featuring developed nations that borrowed in their own currencies, the charts show a dramatic vertical spike in the central bank's balance sheet the moment the crisis hits the floor. This represents the implementation of quantitative easing. The data proves that when a central bank aggressively prints money to purchase assets, it can successfully decouple the collapsing credit market from the money supply, flattening out the depression curve and initiating a slow recovery. In stark contrast, the inflationary registry, which heavily features emerging market crises across Latin America and Eastern Europe, presents a completely different chart profile. In these cases, because the debt is held in foreign currencies like the US dollar, the central bank's balance sheet cannot simply print away the problem. Instead, the historical charts show a catastrophic vertical drop in foreign exchange reserves, followed immediately by an explosive exponential spike in consumer prices and local interest rates. The registry's data proves that no matter the decade or the country, whenever a nation's foreign currency debt exceeds its annual gross domestic product, a structural currency defense is mathematically doomed to fail, and the economy is forced into a hyperinflationary rebalancing. The registry also serves as an invaluable diagnostic tool for predicting the duration and depth of an economic recovery. By analyzing a century of data, the registry establishes a clear baseline for what a typical depression looks like. On average, across all 48 case studies, the contraction phase, the time it takes for an economy to slide from its absolute peak to its absolute trough, lasts roughly 2 to 3 years. The subsequent recovery phase, during which economic activity, employment, and real output climb back to their previous peak levels, takes significantly longer, typically averaging 7 to 10 years. This historical reality is what economists often refer to as the lost decade, and the data registry proves that this timeline is remarkably consistent, regardless of whether the crisis occurred in a 1930s industrial economy or a 2010s digital powerhouse. Ultimately, this compendium of case studies and charts strips the mystique away from financial disasters. It forces us to look at the economy through a cold, actuarial lens. When you look at the registry, you realize that every modern policymaker is essentially playing a high-stakes game of macro-prudential chess using a board that was designed a century ago. The historical charts serve as a stark warning to investors and citizens alike. The laws of compounding leverage are absolute. When a nation allows its debt to grow consistently faster than the income required to service that debt, it is signing an unalterable contract with economic gravity. The data proves that a crash is never a matter of if, but a mechanical matter of when. Chapter 8. Appendix: Macroprudential Policies. When you look at the devastation left behind by a massive debt collapse, a natural question arises. Can't we just stop this from happening in the first place? This is where macroprudential policy comes into play. It is the ultimate toolkit used by central banks and regulatory authorities to manage and manipulate the entire financial machine from the top down. While traditional monetary policy focuses almost exclusively on broad macroeconomic levers, like raising or lowering benchmark interest rates to manage inflation, macroprudential policy is highly targeted. It is a specialized framework designed to look deep inside the plumbing of the banking sector, identify areas where speculative bubbles are forming, and cut off the flow of toxic credit before it can infect the wider global economy. To understand why this framework is so vital, you have to look at the inherent structural flaws of traditional interest rate management. When a central bank raises interest rates to cool down a roaring real estate bubble, it is using a blunt instrument. A high interest rate doesn't just affect real estate speculators, it slams the brakes on every single part of the economy. It makes it harder for a small manufacturing business to buy new equipment, increases the cost of car loans for regular consumers, and slows down overall employment growth. Macroprudential policies solve this problem by acting like a surgical scalpel. Instead of raising rates for everyone, regulators can target specific, high-risk sectors directly while leaving the rest of the healthy economy completely untouched. One of the most powerful and common macroprudential tools used by modern financial authorities is the manipulation of the loan-to-value (LTV) ratio. The LTV ratio dictates exactly how much money a bank can lend against the appraised value of an asset, such as a home. During the height of the 2000 subprime housing boom, LTV ratios across the United States were practically non-existent. Banks were routinely lending 100% or even 105% of a home's value to borrowers with zero down payment. Under a strict macroprudential framework, regulators can step in during a speculative boom and legally cap the LTV ratio at 70% or 60%. This forces home buyers to put down a massive 30% to 40% cash deposit, instantly pricing out reckless speculators, dampening artificial demand, and cooling down the asset bubble safely. Another critical pillar of macroprudential defense is the implementation of debt-to-income (DTI) and debt-service-to-income (DSTI) caps. These metrics shift the regulatory focus away from the value of the physical asset and directly onto the financial reality of the individual human being borrowing the money. A DSTI cap mandates that a bank cannot issue a loan if the borrower's total monthly debt obligations exceed a specific percentage of their verifiable monthly income, such as 35% or 40%. By anchoring the expansion of credit directly to the real organic growth of human wages, macroprudential policy prevents the mechanical decoupling of leverage from income that drives the destructive long-term debt cycle. Furthermore, macroprudential policy completely re-engineers how banks protect themselves against systemic shocks through the use of countercyclical capital buffers, CCYB. In traditional banking systems, human nature leads to a phenomenon known as procyclicality. When times are good, banks feel incredibly safe, so they reduce their reserves and lend out every single dollar they can find to maximize profits. When the crash hits, they panic, hoard cash, and stop lending entirely, which worsens the economic depression. Counter-cyclical buffers force banks to do the exact opposite. During an economic expansion, regulators force banks to set aside an extra cushion of capital. This acts as a forced savings plan during the boom times, ensuring that when the inevitable bubble bursts, the banking system has a massive built-in reservoir of cash to absorb the losses without collapsing or requiring a taxpayer-funded corporate bailout. The appendix emphasizes that for macroprudential policies to be successful, policymakers must overcome intense political and psychological resistance. During the height of an economic bubble, everyone is making money and everyone feels incredibly wealthy. When a central bank director steps in and tightens LTV caps or limits borrowing power, they are widely viewed as the villain who is ruining the economic party. Aspiring homeowners complain they are being locked out of the market. Real estate developers complain their profits are being strangled, and politicians complain that the regulatory intervention is slowing down the immediate economic numbers that help them win elections. Ultimately, this specialized toolkit is the only line of defense against our own collective financial amnesia, Human beings are inherently hardwired to chase short-term euphoria and ignore long-term structural risks. Macroprudential policy acts as a cold, unemotional, institutional counterweight to that flawed human psychology. It recognizes that credit is an incredibly volatile asset that cannot be left entirely to the whims of open market speculation. By continuously monitoring systemic leverage, adjusting capital buffers, and restricting speculative access to credit, macroprudential regulators attempt to smooth out the violent peaks and valleys of the long-term debt cycle, turning what would have been a catastrophic financial heart attack into a manageable, orderly economic adjustment. Chapter 9. Glossary of Key Economic Terms. To confidently navigate the complex world of macroeconomic crises, you have to speak the language of the machine. The final section of Ray Dalio's text acts as a vital Rosetta Stone, breaking down the highly specialized vocabulary used by central bankers, hedge fund managers, and policymakers when the global financial system begins to fracture. By demystifying these terms, we move past the confusing jargon of the evening news and unlock a crystal-clear understanding of the exact mechanical levers that shift wealth across nations during a big debt cycle. The first foundational term we must master is leverage. In the financial world, leverage simply means using borrowed capital to increase the potential return on an investment. Think of it as a financial magnifying glass. If you buy a property for $100,000 using your own cash and the property value increases by 10%, you have made a 10% return on your money. But if you use leverage, putting down only $10,000 of your own cash and borrowing the remaining $90,000 from a bank, that same 10% increase in property value yields a $10,000 profit. You have effectively doubled your original investment, achieving a 100% return. While leverage supercharges your gains on the way up, it operates with equal brutal force on the way down. If the property value drops by 10%, your entire $10,000 investment is completely wiped out. Leverage is the primary fuel that transforms ordinary economic growth into an unsustainable speculative bubble. This brings us directly to deleveraging, which is the painful mirror image process of stripping that debt back out of the system. A deleveraging occurs when an economy can no longer sustain its mountain of debt, forcing individuals, businesses, and governments to aggressively reduce their leverage ratios. Unlike a simple recession, where an economy just slows down temporarily, a true deleveraging cannot be fixed by a central bank merely lowering interest rates, because interest rates are typically already near zero. Instead, the economy must go through a structural rebalancing through a mix of spending cuts, debt write-downs, and monetary expansion. When a deleveraging runs completely out of control, it triggers a debt deflationary vortex. This is a highly destructive economic death spiral where falling asset prices and contracting credit reinforce one another. It works like a mechanical trap. When borrowers are overextended, they are forced to sell off their assets, like real estate or stocks, to get quick cash to pay back their lenders. But because millions of people are trying to sell at the exact same time, the market is flooded, causing asset prices to crash. As asset values plummet, the collateral backing other bank loans vanishes, making the banks look insolvent. Banks respond by freezing all new lending, which destroys spending power, drives down incomes, and pushes asset prices even lower. It is a self-fulfilling loop where the frantic collective effort to pay off debt actually makes the total debt burden heavier. To break this vortex, modern central banks rely on a heavyweight monetary tool known as quantitative easing, QE, often casually referred to as money printing. Under normal economic conditions, a central bank manages the economy by adjusting short-term interest rates. But when a major crisis hits and interest rates hit absolute zero, the central bank runs out of traditional ammunition. They pivot to QE. The central bank creates brand new electronic currency out of thin air and uses it to buy massive quantities of government bonds and private financial assets directly from commercial banks. This injects trillions of dollars of artificial liquidity straight into the financial plumbing, driving up asset prices, lowering long-term interest rates, and keeping the credit system from freezing solid. When a central bank executes this process flawlessly, they achieve what Dalio famously terms a beautiful deleveraging. This is the absolute holy grail of crisis management. It is a delicate, highly engineered economic balancing act. To achieve it, policymakers must perfectly balance the deflationary forces of austerity and debt defaults with the inflationary forces of money printing and debt monetization. If they strike the balance correctly, they print just enough money to offset the disappearing credit. This allows the nominal growth rate of the country's economy to rise above the nominal interest rate on its debt, meaning the nation can slowly and orderly melt away its debt burden over time while keeping unemployment low and avoiding social chaos. On the opposite end of the spectrum lies hyperinflation, the ultimate nightmare scenario of an inflationary debt crisis. Hyperinflation occurs when a currency loses its value at an extreme compounding rate, typically defined as prices rising by more than 50% per month. This catastrophic breakdown happens when a government loses the ability to tax its citizens or borrow money legitimately and decides to fund its massive budget deficits entirely by running the printing presses 24 hours a day. As the supply of paper money explodes, the currency ceases to be a trusted store of value. It becomes a hot potato that citizens try to spend within minutes of receiving it, leading to a complete collapse of the economic system. Finally, we have macroprudential policy, the regulatory framework designed to prevent these disasters before they start. Rather than focusing on inflation or growth numbers, macroprudential policy looks at the safety of the entire financial system as a whole. It uses targeted lending rules, like capping how much a bank can lend relative to a borrower's actual income, to prevent speculative bubbles from forming in specific sectors. By understanding these key terms, you no longer look at economic crises as chaotic, random acts of God. Instead, you see them for what they truly are, a series of predictable mechanical adjustments playing out across the global ledger. Conclusion: so where do you go from here? Now that you have pulled back the curtain on the global financial machine, looked deep into the belly of history's greatest economic storms, and seen exactly how the levers of power are pulled, you are faced with a fundamental question. Are you going to keep looking at the world through the same naive lens as everyone else? Or are you going to use this newfound sight to completely change the way you navigate your financial future? Because here is the cold, hard truth. Simply knowing how the debt cycle works is not enough. Sitting back and absorbing this information like a passive spectator won't protect your retirement account when the next bubble bursts. It won't save your business when credit markets lock up, and it won't help you capitalize on the massive opportunities that always hide inside a crisis. Knowledge is just potential energy. It is completely useless until you inject it with purpose and translate it into real, calculated execution. True power doesn't come from understanding the mechanical script of the economy. It comes from the definitive actions you take once you realize that script is playing out right in front of your eyes. Think about how your perspective has shifted over the last couple of hours. You probably started this journey looking at financial crashes as chaotic, unpredictable acts of God, terrifying events that just happen to us completely out of our control. It's an incredibly stressful, disempowering way to live. But as we traveled from the hyperinflationary ruins of Weimar Germany to the dark days of the Great Depression, and right into the high-stakes digital panics of the modern era, that fear began to melt away. It was replaced by a sense of profound clarity. You started to realize that the chaos is an illusion. You saw that the economy is just a beautifully repeating rhythm of human behavior, driven by the same timeless loops of greed, fear, optimism, and leverage. You realized that while the decades change and the technology evolves, the machine always stays the exact same. That realization is the ultimate competitive advantage. It takes you out of the panicking crowd and puts you in the driver's seat. The empowering message at the heart of Ray Dalio's work isn't about doom and gloom. It is about absolute sovereignty. It proves that when you stop being a victim of the financial weather and learn to read the architectural signs of the cycle, you can build a life that is fundamentally bulletproof. You learn to spot the reckless euphoria of a bubble before you overextend your own balance sheet. You learn to recognize the early fractures of a peak so you can move your capital to safety. And most importantly, when a crisis finally hits and the rest of the world is paralyzed by panic, you are able to see the floor of the depression, look past the fear, and spot the generational wealth-building opportunities that always emerge during a beautiful deleveraging. The financial machine is moving right now, at this very second. The clock is ticking toward the next inevitable cycle, and the waves are already beginning to form on the horizon. You cannot stop the rhythm of the machine, but you have absolute control over how you position yourself to meet it. You can either be the person who is blindsided and swept away by the current, or you can be the master surfer who rides the crest of the wave to unprecedented heights of success and stability. Now the choice is yours. The playbook is in your hands. The mechanics are crystal clear, and your old assumptions have been shattered. There are no more excuses left. You don't need to wait for the perfect market conditions, and you don't need to be a Wall Street insider to start taking control of your financial destiny. You just have to start. Take a hard look at your investments today. Look at your debt, assess your exposure to risk, and start making the proactive adjustments that your future self will thank you for. Do not wait for the evening news to tell you that the storm has arrived. Start building your economic fortress right now. If this deep dive completely changed the way you think about wealth, debt, and the global machine, make sure to like this audio, share it with someone who needs to wake up to financial reality, and subscribe to keep feeding your mind with high-level insight. The next chapter of your financial life begins today. Make your move.